Allow me to welcome you to our media briefing announcing the monetary policy stance taken by the bank after the Monetary Policy Committee meetings that were held over a 2-day period. I trust we are all eager to hear what the governor has to say and to give us the position that the bank has taken this time around. I will not waste much of your time. At this point, I'll just invite the governor to come and address the media.
In our presentation, as always, we'll start with letting you know what decision we came up with over these 2.5 days that we had been meeting. Then give you an overview of the economy. That will also include the global economy. Then I'll focus a little bit on the global economic developments, then turn on to domestic economic developments, macroeconomic outlook, and give you the conclusion, which in effect will be a restatement of the monetary policy decision that we made. At our meeting held the 20th to 21st of May, the Monetary Policy Committee decided to raise the policy rate by 50 basis points to 10.25%. You recall that over the past 5 consecutive meetings we had held the rate steady. And at each of those meetings, we used to indicate circumstances which would make us make adjustments to the policy rate either up or down. This time around, looking at the various elements in the economy, we felt that we needed to make some adjustment. Some of the key factors that we took into account in arriving at this decision was that there has been a build-up in inflationary pressures in the economy, with inflation now being projected to remain above the upper bound, which you know is 8%. So we project that over the coming 8 quarters, inflation will be above that bound. Now, this has come about because of heightened volatility in the exchange rate of the kwacha against major foreign currencies, with the potential to further increase inflation if no action is taken. We see that there has been slow progress towards fiscal consolidation, as reflected in rising domestic arrears, public debt, and external debt service. These factors are still playing out. I think in the previous meeting we did say that there are a number of risks which were stuck against inflation, and some of those could materialize, and indeed some have done so at this point, and they have pushed inflation to above the target range. Now, in terms of what we are looking at here, monetary policy stance that we have taken, or we will continue to take, focuses on maintaining the inflation rate within this policy band, this target range of 6 to 8%. Now, to do this, as we have explained previously, we focus on the interbank rate, which we think should be the reference rate for other rates. I'll come to that later, why perhaps this relationship may not be as strong as we would want it to be currently. But that's the focus of the policy rate, is on the interbank rate. I think that's very important to bear in mind. We used it many times, but I think we have refined it now, because previously we used to show a much broader thing. So the policy band is this brown space here, which is plus or minus 1 percentage points above the policy rate. Then the red one is the monetary policy target range. So what we try to do is this green line, which is the interbank rate. So the idea is to keep it as close to the mid of this range, but anywhere within this is fine. But really, if we are to be precise, it should be coinciding with the red line. So you see from this that it's very close to that, but it did move up compared to the previous period where it was 9.79% to 9.90 during this period. So you can see that this is showing that things are building up in the economy. Also, we noted that since the last time that we met, inflation has been trending downwards. That is in the first quarter principally. What we see is that in the first quarter, it averaged 7.7% from 8% the previous quarter. Now, what explains this movement is that supply of selected food items and the reduction, which was an administrative measure taken by government to reduce the fuel prices, were the key drivers of this movement. But in April, that is after the quarter's end, we see that inflation edged up to 7.7% from 7.5% in March. Both food and non-food were the major drivers, which rose by 0.1 percentage points. Now, graphically, this is what we are showing here. The overall inflation is the black line, and the food inflation is the green, and the brown is the non-food inflation. So when you put these together, you see that this is the position. But you can see that it's beginning to look up when you look at this angle here compared to the previous time that we are talking about. Now, in the first quarter as well, we see that the kwacha was very stable, depreciating only by 0.6%. That's the year-to-date basis. But this did not turn out to be the case after the quarter's end. So we see that after the quarter's end, there was significant pressure on the exchange rate, which depreciated by just between the period 1st April and the 17th May, which was last Friday. We see that the exchange rate depreciated by 14.9%, and that is feeding into inflation, and that explains part of the explanation why inflation is going upwards. Now, what factors drove this? You can see from here how it moved. The red one, this is the US dollar kwacha. You can see how it has moved. Then the euro against the kwacha also depreciated. South African rand also has depreciated against this. I'll come back to this a little bit to show that while the kwacha has depreciated against the rand also has been depreciating against the US dollar. So are other currencies. But for now, let's focus on the movement in the kwacha. Let me give you a bit more insights on this. We try to help you follow what has been happening to the exchange rate, going as far back to August 2018. We have had episodes when the exchange rate just spikes or dips. But more importantly, I think we look at the spikes. If you start the first one, here when it moved up, this one. This was associated with the raw foreign exchange supply, high and lumpy demand for foreign exchange, principally from the Energy Ministry for energy supply. It kind of stayed low, then again it spiked here. We see the turning point here where it came up, negative market sentiments, fiscal challenges, debt, rumors of securitization of Zambia's assets, social cash transfer funds mismanagement, and elevated Eurobond yields. All these combined to feed into the exchange rate, which spiked to that level. As these quietened, we kind of came back to a new path, which was relatively stable, as you can see, until again here, when we see again an elevated and unfulfilled Minister of Energy demand amidst low supply. Supply now also became an issue during this period. So the rate again spiked, but more recently, we see this movement here, which is fed by heightened negative market sentiments, coupled with elevated demand from corporates. Now, give you some more insights, I think, later on when I come back to this on what the demand was and supply of foreign exchange. But for now, just see this movement in the exchange rate, that at every stage, there is something which triggers that movement. So, but all in all, you can see that common to this is this demand for fuel, which tends to come in lumpy, and once that happens, it starts to generate other pressures in the market. So we see that when this is happening, any slight movement is magnified, is exaggerated. So that's where the sentiment story comes from. But when you look at the underlying supply and demand, it's not very different. When you look at the end period, you see that the supply and demand tends to be quite matched. But the intraday dynamics are quite strong, that once it moves up, it catches and people start reacting to that. So the more you talk about, the more that fits into the frenzy. Now, coming to the global economic developments, we see that in Q1, preliminary data suggest that global growth was stronger than anticipated due to favorable growth in some advanced countries. I think the major driver of this has been the US economy. Now, but for 2019 as a whole, I think this is the message which came out when we had the spring meetings in April. We see that there were revisions to the forecast of growth globally. This was revised downwards to 3.3% from 3.6%, which was the earlier projection in January. In 2020, it is projected to remain at 3.6%. Now, this has implications to countries which export commodities, because demand then is expected to kind of slacken. So that is very important to bear in mind in terms of our own economy here. Now, what underlies this movement? What we see is that the issue of collaboration in the global economy is under threat. So these trade wars which have emerged are really creating some uncertainty in how the economies operate. Now, I'm sure you are journalists, you have been following these stories. You see that there has been like tit for tat. This one raises the tariff, the other one responds by raising the tariff. And that's not helpful to coordinated growth. You recall that after the global financial crisis in 2008, the global economy was operating more in a concerted manner. Major central banks were taking concerted actions to try and address issues of inflation, issues of promoting growth through the quantitative easing mechanisms. But this now is under threat with these trade wars, and that's feeding into the global growth. There has also been slower growth momentum in several economies, particularly in Europe. US economy, the UK economy was doing surprising well when the Brexit story was coming out. But now there are some bubbles there which point to some uncertainty. That story also itself is feeding some other uncertainties in the way the global economy is operating. Further, we see that prices of commodities, as I indicated, are affected. Some, in this particular instance, have gone up, but others have come down. Take the case of copper, it has gone up, but it's a reduced level from where it was, say, in Q2 2018. See, it was 6,800, even lower than Q1. So you can see that this trend started there from Q1 2018, further down, slight recovery and a bit of recovery. But projections going forward suggest that there could be some risks to this price. Then you look at oil. Oil has come down quite significantly, which we benefited from in the recent adjustment in the fuel prices that I referred to, plus the stability in the exchange rate that we had experienced. So that helped to do that. So we see that oil prices have come down quite significantly. You see they had reached $74 a barrel to 63.3 cents a barrel. Wheat is bubbling around. Went up, is come down slightly in Q1 of this year. Then maize prices, this has also been up and down. Now, we expect that with some of the challenges that many of the countries, particularly in this region, have faced, this is going to be a challenge because take, for example, the three countries which were affected by the recent cyclone Idai, Zimbabwe, Mozambique, and Malawi. In the case of Malawi, actually, the problem was that they had something good going until these floods came in and they wiped out quite a significant portion. The international community is trying to rally around to help. Even here in Zambia, I think, even in the bank here, people have stepped forward to render support. But what that means is that the grain which is available will be under pressure as we try to help others. Then cotton is pretty much flat, but it has also been coming down. Then you come to sugar. Sugar, remember, it has remained quite flat throughout this period. Soya beans, it has also come down, but recovering somewhat in Q1 of this year. So the global economy has a bearing on what happens to these commodities because that's what feeds all of us. Now, turning to the domestic economy, we see that liquidity, as measured by the current account balances here at the bank, closed slightly higher than the previous quarter. I think the table we want to look at is this one. The open balance was 1.4 billion kwacha. It closed at 2.1, which shows that there had been some increase in liquidity. But where was that coming from? Mainly from net government securities, the maturities that were happening. They boosted that. Our foreign exchange operations also helped that. Small push came from other factors, but net government spending was a major withdrawing influence. I think this has to do with the debt service and all those kinds of expenditures. So the other variable I think here, which is kind of silent but important to look at, is the CIC, which is currency in circulation. Usually this moves is a seasonally affected variable. We normally, when we come into this part of the year, you have a lot of demand for currency for people buying our crop output. And we see there are some parts of the country where this is more pronounced than others. Some border areas also, if the neighbors are not doing as well, you find that there is high demand for our local currency. So it added something to the liquidity that we are seeing here. Then I think I explained this, but perhaps just to explain this chart here, this is the interbank activity. Normally, when there is a lot of liquidity in the system, the interbank activity is kind of muted, but this time it wasn't as pronounced. We see that there was still quite some decent activity. It came down from 46.5 billion kwacha to 45.9, so fairly close, but it came down slightly. Now, the government securities, I think this is a matter you have been reporting on, that the subscription rates have been coming down. This is for real, that we see that if you look at the treasury bills, Q4 2018, the subscription rate was 88%. It went up slightly in Q1 of this year. But if you look at the bonds, it's quite a different story. You see that it was 33% to 29%. Now, this has implications in terms of the government operations, because they rely on this instrument to raise some funds for government operations. So this has meant that for some of the auctions, the maturities could not be met from the funds raised from the auctions, which forces the government then to make good on those maturities. And in so doing, you will find that the stock of government securities has to reduce as a result. So the import of this, that this is declining, but as it does so, it's putting pressure on the yield rates. So you see later that the yield rates have actually gone up quite considerably. Now, here is just a detail of the amount raised in auction by auction. So what we see, the latest auction was that it was in a deficit of close to 1 billion kwacha. So we raised this, the brown one is the funds raised, and the blue is the maturity, and then the gray is either surplus or deficit. In this case, it's a deficit. Now, if you go back, you see that for March of 2017, the whole of 2018 except Q3, we had surpluses in the auctions that we are undertaking. But in the Q1 this year, there was a deficit of 900 million kwacha. Now, here also we'd like to show who is holding what, principally between the residents and the non-residents. So here we are trying to show what has happened to the non-resident holding of these instruments. What we see is that they have moved out, as of now, completely out of treasury bills, so they are all concentrated in government bonds, and their holdings have gone up somewhat to 8.7 billion kwacha, which is an increase of 8.1%. So this has implications, I think, when you are doing some analysis of the pressure on the foreign exchange. We always try to look at what if they decided to take this? Would we have the capacity to pay them out? Although, I mean, that's unlikely because they would trade this, but there is no active secondary market now to trade this. But players have a way of creating the market so they can sell it to somebody else who wants to hold to maturity. Then the yield rates, which I referred to, you can see that because of this pressure in the government securities market, there has been an increase in yield rates, more pronounced for the bond. But you recall, I think the last meeting that we had here, or briefing, we had expressed the concern here where this was crossing, where this is for treasury bills, were crossing, they were higher, so to speak, than the bonds rate, which meant that the yield curve was beginning to be inverted, which meant that shorter term money was more expensive than longer term money. The normal situation you expect is that the bonds would be attracting more yield than the treasury bills because of the time value of money idea. But what I want to stress here that you see in the fourth quarter, the bonds were the 24.34. From that, then this has gone up to that. So this movement, 24, 21, what I would like you to project is way above that. And then when you take into account the fact that inflation is, let's take the recent higher figure that we got, 8%. So you see that the real rate is quite high. And this is the risk that we are talking about. The risk premium is quite high. So ordinarily, you should see people going into this. But there are other factors, of course, that people take into account to invest in government paper. But the subscriptions have been low, which has been beating these rates because the government funding also comes from this. So this is the challenge which is there. Sometimes it attracts investors from abroad, the non-residents, but other times they get more attracted to other markets. When, for example, the US Fed raises the federal funds rate, they would rather go there, even though it is probably a lot lower than this. But their assessment of risk seems to be that that's a better bet than this. So that's the volatility which also gets introduced into our markets. Now, with these nominal rates at those levels, you see that they rub on to the other rates in the economy, principally the lending rate. So what you see is that the lending rate has been coming down, but it's kind of rigid. Yeah? So the average bank lending rate rose to 24.6% from 23.6%. So very close, as you can see, from the yield rates on government paper. Now, the other significance of government paper is that it's treated as risk-free rate. So if the risk-free is that high, this explains why this is high too. And now the banks, these are averages, remember? So individual banks may be loading this a lot more. Now, that it contributes to what we say crowding out of the private sector by the government through this mechanism. They don't have to do anything, but people just look at this and they know where to take their money. So it's important to bear that in mind. Now, savings rates, on the other hand, they have also gone up. But of course, you say the rise is not as much. This is for the 180-day deposit rate. It rose by 9.1% from 9.1% to 9.8%. Compare with that. So the spread is quite high. But then when we look at the negotiated rates, I think I'll come to that later. The negotiated rates tend to be not too far away from those average lending rates. They moved from 22.1% to 22.5%. That's decent, you say. Those who are able to negotiate, obviously, they can get a better rate. But those who just take the rate as given, they get the lower rate. Now, arising from the story I've told them, domestic credit grew by 2.9%. That's not very strong growth. It's growth, fine, but I think if we are to expect the private sector particularly to play the role of being an engine of growth in the economy, it has to grow by much, much healthier levels. Now, when we exclude government, we find that the credit growth grew by 4.8%. This is important in the sense that in the previous quarter, there was actually a contraction. So this is a change direction and the positive, but it's still not quite strong enough to drive economic activity in the economy. Credit to government fell to 1.1% from 3.3%. You may say, well, maybe that's good, but it has implications, as I said, if the government is not getting the money, it's not paying some of its dues, and that comes to bite you later on. So this is just a detail of this information which is here. Okay. Now, money supply has also been quite a challenge, money supply growth. We see that actually in the quarter under review, money supply contracted. But this, to some extent, is consistent with the low growth that we have had in the economy. So we need money supply to grow so that growth can be supported. But as things stand, we see that it contracted after growing by 0.9% the previous quarter. Now, this decline was driven largely by the decline in net foreign assets and drawdown in commercial banks' offshore deposits. So the drawdown into our reserves affects what happens to money supply. So that's something to bear in mind. On a year-to-year basis, we see that money supply picked up to 17.6% from 16.1%. Quarter-on-quarter contraction. Year-on-year, some increase. So this is what we try to show here. This is M3 growth, the brown one, and this is M3 growth quarter-on-quarter. You can see this is declining, but this kind of went up. Now, the contraction in money supply growth is indicative of continuing challenges in sustaining strong economic activity. That's the point I was trying to make here, that we need to have a healthy growth in money supply to support economic activity. But as it is now, it's quite constrained, and that's one of the issues that we need to address as a country. So what we are saying is that during the first quarter, we had the fairly stable situation with respect to the exchange rate, but in beginning of April, pressures mounted. What do we see? That net supply of foreign exchange rose to 212 million in the first quarter from 92.1 million in the preceding quarter. So you can see why some of that relative stability was obtaining. Now, the mines continue to be the major suppliers of foreign exchange to the market. You see there mining and quarrying. The green is the 2018 situation, and the brown is the 2019 Q1. So you can see that, yes, in Q1 it was slightly lower than in the Q4 of 2018, but it was still quite decent. But you look at the usage of foreign exchange, you see that the public administration, which is really debt service, is the major driver of demand for foreign exchange. So the other supply you can see are very small in the period that we are looking at. So this imbalance sometimes is what gives the impulses to the movement in the exchange rate. So here is a detailed information about the supply from the mines. We track it, say, from January 2018 to May this year, up to, I think, Friday. So you see what is happening. The trend is downward. There are periods when it is high, but it's generally down. And that's one of the things we have been saying, that we need more supply. So the issue of diversifying our export earnings is taught by this, because if we continue to rely on this, this is what you are going to end up having constraints in the supply of foreign exchange. So that 84 there is not the full year, of course, the full month rather, but you can see that it has come down quite appreciably. So we thought that it would be useful for you to see how the supply has been faring from the mining sector, how the mines have been faring in terms of supplying foreign exchange. So the yellow line is the year-to-date average, which, as I said, is trending downward. Now, in terms of the demand for foreign exchange, here again, we try to give you a sense when we are saying the demand from the Ministry of Energy is one of the drivers of the movements in the exchange rate. Sometimes that's what triggers that movement. Here you can see, if you look at the brown line, that's the year to average. It has been fairly stable, around 50 plus a month, but you get these peaks. You know, October 2018, it shot up. April 2019, it also moved up. Hence the pressure that you are seeing in the foreign exchange market. So now this is something of a structural nature, which can only be resolved by structural changes to how procurement of petroleum products is done. But for now, what we see being a challenge is that at times they wait to accumulate much kwacha before they go to demand for foreign exchange from the bank. In so doing, it tends to be lumpy. So what tends to happen is that if it was coming 1, 2 million, 3 million constantly like that, you wouldn't have much of the spike. But what tends to happen, as I said, is the lumping of this at a particular time. And once that happens, it sends a signal to other players that there is so much demand in the foreign exchange market. And that triggers some other reaction. And it tends to be overly sensitive, these movements. Here again now, we want to give you a sense of what is happening, because I think sometimes we just talk about the kwacha versus the dollar. So here what we try to do is we compile an index which combines 6 currencies and to see how they fare vis-a-vis the US dollar. So what you see here, the brown, that's the kwacha reference, whereas this is the index of that. So what you see is that also has been moving, meaning that the currencies in that also have been moving, depreciating against the US dollar. So the currencies we include in this are the euro, Japanese yen, pound sterling, Canadian dollar, Swedish krona, Swiss franc. So all these, you can see that they have also been moving. But I think there's a slide area which also shows that the US dollar has been strengthening against the rand. But in recent time, we see that the kwacha has also lost some ground to the South African rand. Now, ordinarily, if, say, since we have a lot of trade with South Africa going on, if the pricing and the invoicing was in dollars, we may not be having some of the pressure that we are having. Sorry, it was in rand, but it tends to be in dollars, and that continues to put pressure on the kwacha dollar exchange rate. Now, we focus more on the kwacha dollar exchange rate here because that's the currency we use for intervention, for pricing of virtually all the imports that we have. So we thought that this would be helpful. We have not shared this before, but we thought, given the interest that they have expressed, this will help you to see what is happening to the other currencies as well. Now, turning to the real sector, this is where a lot of challenges are being experienced right now, in that when we look at the growth figure given by CSO, it's 3.7% in 2018. No recession, but it's not high enough for the objectives of employment creation and poverty reduction. And when we look in Q1, we see that many of the indicators that we look at show that there is a subdued economic activities. And that's a concern that government has, and we have here as people who are looking at the monetary affairs of the country. Copper production, you see that contracted to 195,244 metric tons from 220 and 39 metric tons in Q4. Cement production also declined under the quarter review. There could be some seasonality there because it was still rainy season. Maybe people are not buying enough, so it didn't encourage the producers to produce more. So we'll see in Q2 what happens, because that's usually the peak of construction. See, then real consumer spending also declined under the quarter review. I must stress here that our GDP growth in our country increasingly is being driven by retail and wholesale. Now, you shouldn't be surprised, because when you go whichever direction from here, you find the mall is there and there are people purchasing. So that's what is driving that. But in terms of the productive sectors of the economy, there is this challenge that we have to address. We can't continue just to be consuming items which are produced by other people, because in return, we are giving money, they are giving us goods, they are creating more jobs. But us, we can only create jobs in retail, which tend to be low-paying jobs as well. So they don't contribute to the taxes, which many of you are doing through income tax, because they are below the threshold. So there is that challenge that we have to address. Electricity generation has also declined. I'm sure you have read the papers. There's even an endeavor which ZESCO is calling to deal with this load shedding. So that's a challenge that we have to rise up to as a country. Now, when we look at the external sector, we see a slight improvement compared to what we had earlier on, particularly in Q2 of 2018. Now, these figures are revised figures. I think when you look at the table, which you might have from previous presentations, you may see different figures, but these are informed by the scheduled revisions that the economics department does when they do the surveys. So what we see here now is that there is a surplus, but it has also narrowed. Now, the narrowing of that surplus has implications on how usually you find that if you have a deficit, you draw from the financial account to pay for the current account. But here, it means that this surplus probably is not high enough to support other activities. So what happens, I think you heard me say, there is a drawdown on offshore accounts of the banks to try to mitigate that narrowing of the current account. Now, from here we can see that these are exports. You can see they are coming down, but the imports came down much faster than exports. So that's what gives you that surplus that you have. But otherwise, the numbers are not robust enough for us to say the external sector is stable. So this has impulses on the foreign exchange market as well. Turning to the fiscal side, here we don't have much to say except something which you have already heard, because the minister does now make pronouncements on the quarterly basis. But we thought it would be important also to highlight some of the things that are going on there which have a bearing on inflation that we are talking about. So what we see is that the fiscal deficit on a cash basis in 2018 was 7.6%. This was above the 6.1, which was the target. So that's the issue when we assess, is there fiscal consolidation or no fiscal consolidation? That's part of the story there. So this is higher than that, which means that there is more demand for resources than there are resources to meet that. Now, our kind of deficit also we have seen here, because ordinarily with what we have as high deficit as that, should have resulted in a lot of liquidity into the economy, because there would be circulation of money. But because of a high debt service, this money which is collected from taxes ends up going into debt service. So it's starving the domestic economy of the much needed resources. So you see there is a rising domestic arrears as well, which is are putting pressure on other economic agents, notably the financial sector. You have the people who have borrowed from there not being able to meet their obligations. So this is what is of import here, why we highlighted that the deficit is putting pressure. 7.6 obviously is better than 7.8 the previous year, but still high compared to what the government had set out to do. So that's the challenge that we have to address. So for our part, what we are urging is that we need to have urgent and effective implementation of fiscal adjustment measures so that we can get the fiscal deficit on a sustainable trajectory. We get debt service also to reasonable levels so that it stops being a drain on the reserves that we have. Inflation itself, I think I explained this earlier on. Let me not bore you with that. Let me move on to the next slide. I think this I already did. GDP growth, I think I did say the components there in terms of the activity, but the upshot of this is that the economic growth is projected to slow down, mainly on account of lower agricultural production, mining output, as well as constrained electricity generation, which I refer. There are quite a lot of downside risks to this growth. These include delayed implementation of the fiscal adjustment measures, rising domestic arrears, and subdued credit to the private sector. So all these combined, they are putting pressure on growth to go down rather than go up. So the upshot of this is that we need to do something to address this, because it's not sustainable. More so in terms of employment creation and sustainable poverty reduction. So we see inflation then in its turn is affected by this. In the case of inflation, we're saying there are upside risks, meaning there are those things which, if they happen, they are going to push inflation further up. One of which is lower maize output. Next is continued elevated fiscal deficit. Third, high debt service payments. And the fourth, decline in international reserves. These risks are likely to impact through the supply side as well as the exchange rate and the expectations channel. Because once actors, which yourselves and the investors, think that these are not addressed, then they start agitating, and that pushes the exchange rate to move in a very volatile manner. Now, let me just reiterate what we are saying. What is really the upshot of our decision? In arriving at that decision, we had to balance out what is it our primary objective as a central bank. Our primary objective is price and financial system stability. Now, you might say what the action we are taking militates against the objective of raising growth, because it's going to raise interest rates and so on and so forth. But the thing to bear in mind is that if inflation, the exchange rate, get out of hand, you will not be able to realize the growth that you want. You will not have stability in the market. So in the short term, what we are saying is that we need to address this pressure which is exerted on inflation and through the exchange rate channel. So this raise in the policy rate is to signal our commitment that we are committed to that target which government gave us of 6 to 8%. That hasn't changed. So we have to take measures which will enable us to bring that. Because if we have relative macroeconomic stability, then we can get back lower interest rates in the process. But in the immediate term, obviously, this has the effect of raising interest rates. But it's one of the bitter pills that you have to swallow to be able to arrest the situation. I'm sure we all get sick sometimes. When you are sick, then there are certain types of medicines you don't want to take because they are not palatable. They are bitter or something, or they make you sick. But you are urged to take them, because if you do, and they agree with your chemistry, you will find that you get better. In fact, you find people who are screaming, taken to hospital, when they are given an injection, next they are laughing. A thing called inflation, which is being pushed by the exchange rate. If we don't take any action, then we'll get the inflation getting out of line, the exchange getting out of line. Then you are all going to be complaining what is happening. But here we are now. We are saying we raise the policy rate. We are taking other measures, I think, which we have indicated. We are raising also, by doing this action alone, the access to the overnight lending facility of the banks is also being tightened. But we have added another 1.75 percentage points to that cost. Because look at it this way. When the exchange rate is moving up, it means that there's someone who has the kwacha to buy the dollar. So it's the kwacha that we are interested in. That's what we can affect most fundamentally. So this is the background to why we have taken the decision that we have taken, but it's not the only thing that is needed to arrest macro instability and support growth. We are looking very much to the other measures, the other side, the fiscals will do, and then we'll collaborate on this to see if that kicks in, we may have to adjust the rate down as we have done in the past. So I thought that was important for you to get a sense of why are we doing this, which is going in the opposite direction. But that's the rationale behind this decision that we have taken. Thank you very much, and God bless.